What's going on, everyone? Welcome to another Nomad Hedge market video. So this video is going to be a little bit different today. We're going to switch things up because we're going to have a look at the inverted yield curve and their recessionary signals. Now, if you're a little bit unfamiliar with this term right now, don't worry. I'm going to break this down for you in just a moment. But briefly, when we take a look at the inverted yield curve, it can actually act as an early warning system for a recession ahead, okay? A potential recession ahead. It's like a secret language financial markets use to communicate with us. And trust me, there's some very important aspects here you need to keep an eye on, especially when this whole phenomenon starts to, flip back to normal. So being able to identify when to sell before the market starts factoring in or pricing in a recession is key here. Okay, and that's exactly what we're gonna take a look at today. But before we get started, make sure to hit that subscribe button if you haven't already, and don't forget to give this video a big thumbs up. All right, let's get into the video. Okay, so let's take a look at this chart here, and what we have right in front of us is the inversion of the 10-year minus the 2-year. Okay, so we're seeing the spread right here, and basically just to sort of like explain what this is, normally when the 10-year is yielding more than the 2-year, we are then in a healthy market environment. For instance, let's just say that the market is pricing in 3% for 10 years and maybe 1.5% for 2 years. Okay, this is the until maturity, right, of these bonds. But we have an inversion when the 2-year is yielding more than the 10-year. Okay, so as if the 10-year would yield 1.5 and the 2-year would yield 3%. That's exactly what we're seeing right now, although the numbers are a little bit different. What I want to do in this video, basically, let's move on to let's go to a monthly chart here and make this one a little bit better. Actually, let's plot the S&P 500 and let's make a line chart here just to make this whole visualization a little bit easier. And also let's plot in the recessions here. Okay, so basically what we're seeing right now, this is the horizontal line right here representing 0%. Okay, so every time we're below this thing, we have inversions. Let me just move this one up a little bit right there. So what I want you to notice here, every time there's an inversion here, most of the time, it's been followed by a recession. The green vertical lines here are recessions in the US economy. We have the S&P 500 here. Now, the key here, what I want you to understand is that inversions doesn't necessarily mean that a recession has started. Inversion is warning you of a pending recessions. It's not until we uninvert here, when things going back to normal, that the recession typically starts. Okay, so while we are in an inverted mode, the market can still be rising. Okay, so what happens is that once this uninversion takes place, that's when we typically see new lows in the markets, especially the S&P 500. And that's the whole point of this video. Let's take a look at another example here. So this is the dot-com bubble, right? So if we take a look at how the market performed back then during this inversion, the market was still going up here, okay? It wasn't until this thing started to uninvert that the market peaked and made new lows. What typically happens is that the market is starting to price in a recession while this thing is going up. Okay, so the Fed typically responds in this scenario. They cut rates, they do QE, and they try to stabilize things. Now, if we move forward here, we have the housing crash here back in 2007, 2008, which led to the great financial crisis here. You can see here, once this thing was inverted, the market was still going up right there. It wasn't until after the uninversion happened, when the market peaked and we made new lows here, pricing in a recession. That's the key here. Now let's move forward here and take a look at what happened. This was in August of 2019, miraculously, as if the markets, knew that something was wrong in the economy, because the market is always trying to look at, the latest economic data. They're looking at employment reports, ISM, manufacturing, all the kind of stuff, job openings. Something here, market participants in this time, during this time, August 2019, sensed that something was wrong. And so what you have to remember is that the market always trying to price in something happening maybe 6 to 9 months in advance. Okay, so what happened after that period? During this uninversion here, we got the COVID crash. It's so fascinating. Like it's almost as if the market knew that COVID was coming. This was your early warning here in August of 2019, and we got this small recession here. Now, pay attention to what we're seeing right now. This is a huge inversion we're currently finding ourselves in. And we're switching back now to a daily chart. And notice this channel here. It bottomed here in March of 2023 and it started to tighten up here. All of a sudden we broke out from this channel. Now what I noticed was that we left an open gap here. And I was tweeting about this. I made a video previously saying this thing is not going to uninvert until we have closed this open gap. Now we're almost there. We're almost, finishing off this closure of this gap here. But the question now is this thing just going to move sideways from here and the market is going to be inverted for maybe a year or two from now? Or is this thing going to bottom from here and then we're going to uninvert from this level? Obviously, I'm going to keep an eye on this as we're nearing the closure of this gap. So we could find some potential support here and then we'll move higher. Now, the key takeaway here, I'm not convinced until we have broken above this high here. This is your early sell signal right here, okay? And this right here, if we're crossing above this horizontal line here, this is your ultimate sell signal. And that is precisely why I treat this market as a sucker rally currently. We're finding ourselves within a sucker rally. So if you take a look at what happened here, we had this bear market right here, and I treat this as an A, wave A. What we're seeing right now, this was pretty much during the whole 2022, okay? So this was 2022. Right now, within 2023, we're finding ourselves within the sucker rally. Now, we could make new all-time high as well. The sucker rally could be, they could be very extreme. They're typically associated with people thinking that we're going back to normal and that we're not gonna make new lows here. And if we take a look at the inversion here, based on historical data, whenever this thing starts to uninvert, that's where we're making new lows in the market. So once this B wave is finished, we're going to most likely see another low here, okay? And that will complete an impulsive move towards wave C. Now, typically, wave C, this is wave A here, the duration and length of wave C typically equals of that of wave A. So we could see wave C materialize in the same manner as wave A. Okay, so that's important here. So I'm going to obviously keep an eye on this. And as soon as this thing starts to uninvert, I know that we are most likely peaked here. We finished wave B, the sucker rally is done, and we're heading lower for wave C. Now, obviously, I'm a buyer here. I'm bullish. I do hold long positions. I believe this is a great time to make a lot of money because sucker rallies are really good. They're better than bear market rallies. What you're seeing here are bear market rallies. They're part of this impulsive move downwards, right? And people, they're trying to swing trade this, making a couple 10, 12%, sometimes 15%, best case scenario, maybe 20%. But here, we could say we're seeing stocks like Nvidia going up 100%, and so Nasdaq and the S&P they can go up 20% as well. This is the main difference here between a sucker rally and a bear market rally. And the sucker rallies are very extreme. It's typically when we see a lot of net short positions being covered, and so you see sharp moves here towards the upside. I'm going to switch back now to the daily chart and zoom in a little bit here. So basically, this open gap here is telling me that we're not going to make new lows here if this inversion. We could make new lows here, but I don't think so because we broke above this channel here. And I'm looking close. I'm going to watch close of this open gap. Once this thing starts to move towards the upside, I'm going to watch this level right here. This is your early sell signal. I just want to repeat this. This is your early sell signal. So when I talk about an ABC pattern here, I'm not only referring to the S&P 500, I'm referring to individual stocks as well. Well, there's certain stocks out there that already bottomed and are obviously heading higher. There are only 500 stocks in the S&P. And so, but when I look at the Russell, when I look at the Nasdaq, the S&P 500, and the Dow Jones, they're all in this wave B pattern right now. And that is why I treat this as a sucker rally. So keep an eye on this. I'm going to obviously keep you guys updated here. And once this uninversion starts to occur, and we're gonna see a lot of momentum here towards the upside, and the market is still gonna go up, in that scenario. So once this thing starts to uninvert, you want to be ready to sell and be informed when things could get very ugly ahead. So that was pretty much it with this video. I didn't plan this at all. Just wanted to explain fairly quickly what this was all about. And What's interesting also, I've read that the 30-year, if you look at the 30-year and the 3-month, this thing uninverts first, and then it's followed by the 10 or 2. You have to look into that a little bit deeper and see if that's correct. But the 10-year, 2-year spread is typically a good indicator to see when recessions or new market lows are pending ahead. So we could actually see that through this uninversion, and based on historical data, it proves just like that. So it's about 90% of the time, every time this thing is uninverted, the markets have done new lows. So that was pretty much it for today's video. If you made it this far, thank you so much, and I'll see you guys in the next one. Don't forget to subscribe and like the video, and have a great day. Goodbye.